promise of financial repression is that it will hold down government borrowing costs and reduce government debt levels. But critics argue that financial repression merely targets the middle class and therefore harms the economy. Chris Hart, Chief Strategist at Investment Solutions, joins us for more on this subject, which is very close to your heart, isn't it, Chris?
Something like that, because you're seeing this more and more, in the world where you've got an over-indebted situation. And, governments have got too much debt, and how do you actually get rid of it when it becomes unpayable? And unfortunately, from a political point of view, the indebted are more powerful than the saver and investor. And so we're going to see efforts to actually transfer value from the saver investor to the actual indebted. And subdued interest rates is one of those techniques where you've got interest rates below the inflation rate, is one way you can take value from the saver and investor. And we're seeing more of these measures, but you also think things like capital controls, it traps people in there. It's when governments start to ride roughshots over property rights, and we don't appreciate what, where that means. If it's yours, do you have control and the use of it? Because sometimes you own it, you've got the responsibility of the ownership of an asset, but repression is where other people think they can also enjoy the fruits of that, of that particular asset, and unfortunately we see too much of that.
Mark, let's bring you into the discussion.
It's interesting. If my economic history serves me correctly, in the post-war era we had something similar, I think.
Very much so. The term actually was coined in 1973, really referring mainly to what was happening in the third world at that stage.
Yes.
We didn't have the concept of emerging markets at that point. But it was also used by countries who run up debts through the Second World War, and the end result is a country like Britain ended up at the end of the 70s as the sick man of Europe, as a combination of things like nationalisation, suppressed interest rates, high inflation, etc. Really wiped out quite a bit of wealth while the government was trying to actually deal with the actual consequences of the Second World War.
And we're seeing something similar re-emerging?
We're starting to see it again,
in a different
because
context.
Well, this time it's to deal with the global financial crisis. Governments have racked up debt. Debt levels are actually are hyperinflating at the moment. It's actually phenomenal how quickly debts are going up, especially relative to GDP. And the expansion of government has also been, in a sense, that government is becoming an end in itself rather than there to serve the people. And we're seeing this increasingly, whether it's France or Greece or whatever. And so in some instances, while you've got the concept of a zombie bank, for instance, the bank that's there, it opens its doors, etc., but it can't lend because its balance sheet is too weak, we're starting to see the phenomenon of those zombie governments where they're there, they tax you all right, and they're there just to service debt that's been incurred in the past, but their ability to actually deliver benefits and services, etc., is being severely hampered. And you're seeing that in the Irish government, the Greek government certainly are becoming zombie governments.
Silo, you've got an opinion brewing.
Yeah, I was going to say that I'd love to infer that you would then prefer you are in the pro-austerity camp rather than the method of doing things as in the United States. But perhaps it's not that simple, because the United States seems to be coming out of this better than the Eurozone. Yeah,
well, there's less at this stage, I think, because there's ability to kick the can down the road. The capacity is far greater in the United States. So
is that because of the reserve currency aspect?
Yeah, so you can hide the problem for longer. But the problem is the same, it's identical. The single currency does provide rigidities. It's not the single currency's fault. It's a case of, in any economy, if you're consuming more than what you're producing from a wealth production side, you will land up in trouble. And the measure of GDP is a problem, because it doesn't really distinguish between wealth producing activity and wealth consuming activity very strongly. And so we've got the mistaken belief that government expenditure is adding to the GDP, whereas in actual fact it's part of your wealth consuming activity. It's a transfer effectively of resources from a high multiply activity to lower multiply activity. But unfortunately, this is, when you become an end in yourself, it's a problem.
A quick one, Hlelo,
yes.
and then we've got to go to our next story.
I think that Mitt Romney would have loved what you're saying as an accusation against Barack Obama, but
No, it's not a political thing, no.
I know. I know it's not, but he would use the same thing. But can you help me with this? If the United States had not indebted itself to the extent that it did, in trying to get out of the recession, where would it have been right now? Where would the economy have been right now?
Well, the point is that the route that they've gone is in fact destroying capital. In other words, zero interest
Sure.
rates, quantitative easing. In other words,
Sure.
that they're destroying the very resource that they need to actually grow the economy.
Did they have an option, is what I'm saying? Did they have
Yes,
an
they
option?
did. They could have
Which
taken
was?
a short, sharp recession, right, and actually reset and actually allow bankrupt industries to fail. Instead, you've got organizations that have failed, that are drawing resources out of the rest of society, which is not the right way to actually go.
I don't know.
And I know some people don't like that solution.
And
because
the
it's
debate is
painful.
just heating up, but we've got to go another day, another time. We'll be back with more discussion.